everyone, welcome back to my learning platform where my goal is to explain a math concept or economic concept in under 2 minutes. Today we'll be talking about the types of bonds. So the types of bonds are corporate bonds, treasury bonds, international government bonds, municipal bonds, agency bonds, green bonds, and bond EFTs. So corporate bonds are issued by corporations to raise funds for operations or growth, and the risk and return varies based on the issuer's credit worthiness, and higher risk can mean higher return. So key considerations for corporate bonds are always conduct due diligence on the issuing company before investing. Treasury bonds. They're issued by the U.S. government and maturity long-term with 10, 20, 30-year bonds. Their risk is very low, backed by the U.S. government. Yield lower than other bonds due to low risk and price sensitivity, prone to price fluctuations with changes in the market interest rates. International government bonds issued by foreign governments. Diversify always for geographic diversification in your portfolio. Risk may include political instability and exchange rate volatility, and benefits are potential for higher yields than domestic bonds. Municipal bonds issued by states, cities, or counties to fund public projects. Tax advantages. Interest is often exempt from federal taxes and sometimes state and local taxes. Risk and return generally safer but can have varying risk levels depending on the issuer, and used ideal for investors seeking tax-free income. Agency bonds issued by government-sponsored enterprises, GES, like Fannie Mae or Freddie Mac. Risk not directly backed by the U.S. government but considered low risk due to the government affiliation. Usually higher than the treasury bonds, and call risk. Issuers can repay the bonds before maturity. Green bonds issued to fund environmentally friendly projects like renewable energy. Benefit allows investors to support sustainability while earning interest, and risk ensure the projects funded are genuinely eco-friendly to avoid greenwashing. And finally, bond EFTs. Just a description is exchange trade funds that invest in diversified portfolio or bonds, and benefits are broad diversification across bonds, lowers interest rate threshold and compared to individual bonds, and liquidity and price transparency. But the risks are subject to interest rate and credit risk like individual bonds. This is some of the types of bonds.